Here we go. All right. So today is options expiration. It's a major options expiration day of the month. So I think what's the last one? Next to last Thursday of every month is options expiration. So you see a lot of volatility. Today we had, if we look at the market movers, we can see we had a good report, earnings report from Netflix. They didn't have great earnings, but their subscribers grew more than expected. So
turn left on
a lot of
Cottage
times
Grove Road.
There's whenever one stock goes up in a group, the other stocks kind of follow. And right now we have Netflix used to be a part of the thing, and I don't know, it'll probably be forever connected to Facebook, Amazon, Google, yeah, so, and Microsoft, and a couple of the other big ones. But so you see, Google went up today too, 4%. You have a lot of layoffs in different companies. I guess that happens around recessions. So there's a lot of slowing. The companies that we're following are not going to grow as fast as they have been, and it's probably going to be a year or year and a half or so where we have flat growth. But the important, I'm sorry, go ahead.
I was going to say, some of these companies, if you look at their hiring the last 2 years, the tech companies especially, they did massive hiring the last few years. So their workforce is actually bigger than it was maybe in 2019 by quite a bit, even with the layoffs. But you have to look at those numbers kind of on a per company basis.
Amazon was like one of the poster childs for that because they thought that COVID would last forever, the lockdowns, and there was a lot of pull forward. Like people bought toilet paper they didn't need, but now they're not going to buy toilet paper this year, for instance. And so there's a lot of sales they were expecting, and a lot of good times that were priced in when they made all those hires. And now they're cutting back basically across the board for a lot of big companies. So let me see. So let's see what else is happening here. So we have Goldman Sachs had a bad earnings report. I guess what they said in their call, they got into personal credit cards. The thing was called Marcus, like dealing with customers. And a lot of times when you deal with customers, you have defaults. And where, Goldman Sachs is really good at business banking and trading, that's where they make most of their money. And they were tiptoeing into this customer part of the world, and now they're sorry for that. But you see, the other stocks that are going down, Eli Lilly, they had a drug in trials, and the government didn't fast track it, and they said they want more information. So this is for an Alzheimer's drug, and they already have like a really good weight loss drug that's probably going to be, Jim Cramer says, one of the best selling drugs of all time. And if they get this Alzheimer's drug, that's just exponentially great for the company. But that's a setback for the Alzheimer's drug. What other things we have in common? Okay, so we have banks. This Silicon Valley Bank, they posted like a good earnings report. I guess they do a lot of business with the people in Silicon Valley. So I guess all these smaller banks kind of rallied with that. Very similar to how Google rallies whenever Netflix goes up. Let me see. What other things can we see from this? Okay, let's look at the S&P 500. You can see that we really are still, we haven't broken out of our long-term trend. What I'm going to do is I'm going to draw the lines in real time just so we can do it together here. See where we're at as of like right now with this 1% gain. Okay, that's pretty close to yeah, it's still pretty close to a downward trend. So didn't look like we broke out of that last week. We were close, but we didn't. So you just have to assume that, let's look at our talk here. Okay, the review of the predictions from Dan Niles and Leon Cooperman. Dan Niles thinks we're going down to 3,000. That's the fair value of the S&P 500. That'll take us down one here, up one, and then down another one. So he thinks we're going to go down to there is the fair value. The reason why this, he's looking at the fair value of the S&P, and right now the S&P is not going to be growing, or maybe it's going to be flat for year over year, or less than that. So right now the S&P is trading at like 18 times earnings. He thinks it should trade around 14. So Leon Cooperman says 5% chance of breaking out, and they both say that we're going to be like in this range for the rest of the year. So we'll keep those in mind. But if we look at our graph here of the S&P, right now we're basically at we're hitting the top of this range. According to Walter Deemer, we had this time right here. This is called breakout momentum. You can see the amount that this went up in a short amount of time. Its advanced declines, advances are like 2-to-1 to the declines for a period of time. And that's supposedly a really good indicator that we're going to have a rally after that. But I think the next stop could be down. If we don't break through this top part of the channel, next step might be down. So you have to keep that in mind. Looking at the calendar, we have earnings coming up pretty soon. So we went through the bank earnings this week. Next week we're going to have, I mapped it out, we have some more regular stocks earnings. Then we have the tech earnings going up to here. And like you saw today, Netflix had better than expected subscribers, so it rallied that stock, and that could take the whole sector up. When we look at what I did was I mapped out some of the stocks that are going to be reporting in January. Next week, we have Verizon, Johnson & Johnson, Microsoft on Tuesday. Then we have Athena Health, Boeing, AT&T, and Abbott Labs on Wednesday. Visa and MasterCard are on Thursday. And then we have, the week after that, we have Apple, Meta, right around the time that the Fed is going to have a meeting in February. So this is all going to be before the meeting, and then Amazon's reporting. So these are all going, one good earnings report, could be the whole sector and the whole stock market. Right now, what we know from Apple and Google, where's Google? Google is going to be reporting next on the 30th. So what we know about Google is they do a lot of business overseas, so they're going to be affected by the weaker dollar in a good way. And Apple, it was selling off on fears that it wasn't selling enough phones in the fourth quarter because they couldn't get enough from China. But we have indications from the telecom companies that there was plenty of supply. If you wanted to upgrade a phone, you got it. iPhone 14. So that could be good for Apple. And Meta, everyone basically left it to die off. And if they if they show that they're not spending as much, it might be in conserving money. That could make the stock go up. At Amazon, I heard some rumors that maybe Jeff Bezos might be coming back in some way to help out. So if that happens, that could help the stock a lot. So let's look at some of any comments for anyone? Okay, no comments. All right, so so we're right in the middle of earnings season now, and let me see. We have the first half of the year pretty much yellow because the consensus, everyone on the street is saying that we're going to have a really bad time. If this is a recession, then companies won't earn as much. And at the end of recessions, usually the good companies snap back and are able to resume their growth rates. So for me, I'm assuming that we're going to be, flat to down 5 or 10% in the first half of the year. And then at the end of the year, it's going to be back to normal. So that's good to keep in mind. In February, we have a holiday on the 20th. Remember that. And on the 1st, we have a Fed meeting. That's a good, that's coming up pretty soon, 2 weeks from now. And what else? Okay, so that's the big picture for this. Now, let me see. Okay, we have unchanged in the 10-year and 2-year. We can't say anything more about that. The Fed is reducing its balance sheet, and that's like for $92 billion a month. That's like a mini interest rate hike every month, even though they're not announcing a rate hike. So we have to realize that's happening, and that's not good for stocks. They're probably done with this balance sheet runoff a year from now or so. Okay, so the catalyst for the market to go up, the only thing of this whole list we can see is probably earnings. It's earnings season, and that could help the stocks. Right now they're overbought, but because of the there are times whenever there's extreme price action where there's 2-to-1 advance to decliners, then it's going to be overbought, but it's kind of a thrust or some kind of really good momentum in the market. So we don't have any good catalyst for the market to go down either. So non-event week, it's like a no up. Now we're still sticking with these theories where the low peg ratios are going to do better because they're not as overvalued, and we're looking for safe business models. And in the next year, we're going to, if you're interested at all in a dividend or some kind of income part of your portfolio, there's a 60-40 kind of an idea where you have 60% stocks, 40% bonds. Now's the time to start looking at the 40% if you're interested in that. I'm not interested in it, but I have 40% in dividends, so that kind of counts. So this is the kind of time. This is the time where you're probably not going to get a really good time to put money in some yield for. Well, this is one of the best times in the last 10 years to get that part of your portfolio taken care of. Okay, anything else? Went through that. Okay, oil is up 3% since last week, and I think $78, $80 is still a low price for oil. By the end of this year, if we get out of the recession, that will be back up to $90 a barrel because there'll be more demand and the economy is recovered. But in the meantime, if we do get into a bad recession, it'll go down. The price of oil goes down with that because there's not as many tractors going in the world, moving things around. Okay, inflation hasn't changed. It's still 6.5%. And the U.S. dollar hasn't really changed a whole lot since last week. But we know from the dollar going down that this week we're going to have, it's been going down. So this week we're going to have companies starting to say the dollar was a help to our earnings. And Procter & Gamble said that this week. So other companies are going to say the same thing, most likely. That's that at least gives companies a 5 or 10% boost to their earnings, I think, this quarter. Okay. Any questions on that? Right. Let's look at the S&P. Okay, so we're still in this ugly channel. This channel where we're going lower highs, lower lows. We do have the opportunity with earnings to maybe try to break out of this channel. We don't know. But it seems like until the Fed says we're done raising interest rates and people, that sinks into the market, then only then we can start going back to normal. Right, and we're just following this path set by these two people, Leon Cooperman and Dan Niles. Seems like we're in this pattern here. Just keep on going down this until further notice. That's our pattern. Let me see. We already said that the DXY is unchanged. Fear, greed. It was greed 2 weeks ago. Then it was neutral. Then we're going towards fear every week. We're getting closer and closer to fear. So, but right now it's neutral, so we can't really make a whole lot of that. Whenever it's extreme fear, that's the time when people are just selling everything, and it's time to start looking to buy things. Whenever it's extreme greed, it's the time to lighten up on things. Now, the VIX is 19.31. It's about complacent right now. People aren't buying protection, and they're not really super over excited in buying things. But if you look at there's an inverse correlation between the S&P and the VIX. So, this is not the time to buy the S&P. It's a time just to watch. It's the opposite. So so when the VIX gets down to 20, that's when the traders, sell the S&P. When the VIX gets up to 30, then that's when traders buy the S&P. So we have that inverse correlation. So let's look at the news story that came out today. NASDAQ futures rise on Netflix boost. And the thing to keep in mind with these stocks is they trade in groups. So whenever one stock has positive action, a lot of times the other stocks that are associated with it go up with it. So, I think, these FANG stocks will always trade together, it seems. And people were worried that Netflix had we knew that it's been expensive for a while, but they had problems where people weren't paying, they were sharing their accounts, and they were losing market share to other people. But even after it dropped this much, it's dropped in half. Even after that, we can see that its forward PE is 30, and that's still pretty rich for this environment. Its PEG ratio is 2.48. It's always had a really high PEG ratio and a really high PE ratio. But now that there's competition, it looks like, and these numbers are really good. They have a business where they don't have a whole lot of expenses. They have servers that they have to run, and they're downloading a file to watch a movie. I mean, that's pretty simple. And that's why their return on equity is good and their profit margin is good. They spend a lot on advertising to get customers, and that's their biggest.
They didn't create their own content, so that should be a big cost.
Oh, I didn't think of that. You're absolutely right. They're actually, that's what sucks in new users, the new shows. So they have to constantly spend on new movies and shows. So until now, they've gotten away with, they had a 70 to 150 PE for such a long time. They were spending like crazy to get all these shows that are interesting that people would subscribe. And now there's like a reckoning where they have some serious competition with Disney, and they can't just continue to spend on content and spend on advertising when you have comparable. I think Disney's actually has more customers than them now. I'm not sure, but
Disney's having their own problems with Disney Plus. I think that the prices are going to have to go up because they've reported a lot of big losses on their Disney Plus side, and they just had the CEO shakeup, and I think there's a real re-examining of how they spend that money.
Right. So yeah, Disney. We're going to go over Disney a little bit later on, but Disney is they have. It's a media company. This is a media company too. Netflix is the only pure play streaming media company. Disney, you have like the theme parks. You have a lot of different ways for them to make money. They have a box office. They make movies. They sell Mickey Mouse dolls, whatever. But the thing is that Disney had in order to compete with Netflix, they ended up buying all kind of content, and they spent on content. They spent way more than they should have for Fox, and they got themselves into debt. And that is one of the biggest problems for Disney right now. Is Bob Iger, the guy that's the president now, he was the one that did that deal, and it's universally like really they overspent for it. They didn't really need it at the time, but anyway, they have it, and because they have to spend a little bit of time working off that debt and not growing as much and paying off debt instead of putting that towards more content or whatever. So yeah, they do have those problems at Disney, and it's not like a pure play either. So, but Disney brought in their old CEO, so that was a big surprise. So they're thinking they might return to the way they used to be. They used to have a dividend. They don't anymore. And so I'm going to finish up with this. We'll go over Disney a little bit later on. I didn't. Okay, well, anyway, I was going to go over. Let me go over. I was going to go over Disney's growth rate just to see, not Disney, but Netflix. It's probably growing like 17%. I thought I put it on here. I guess. Okay, so while we're talking about Disney, let's look at their earnings projections. There was a article that basically listed all the holdings of a certain company and hedge fund, and one of them was Disney. So I said, let's look at Disney, and I looked at it's for a big company. It's a pretty decent growth rate. It's 13, 17, 17 for the next 3 years. That's the earnings projections. I think that's amazingly consistent and good for a big company. But its PE ratio right now is 24, and so that makes Yahoo thinks it's fairly valued. But when we see these numbers, it seems like it's overvalued by 1.4%. So whenever Disney, let's look at whenever Disney sold off at the worst of the pandemic, it went down to a PEG ratio of 1. And that was like in the 70s or 80s. So Disney. So this is an example of, we keep track of, this is a quality company that's reliably growing. They have some of the best franchises in the world. They got Marvel Studios for like $4 billion, and now they're making $4 billion on just one Superman movie, or one of their movies. So let's look at their chart and see what they did during the pandemic. Okay, so this is the pandemic right here. It went down to 85. That's the same as it went down to in Christmas time. So I guess 85 would be a peg ratio of 1. That's an example of, if we keep track of these quality companies, there are going to be market sell-offs. And whenever there is a sell-off, we have to look at these earnings estimates, make sure that, they're not changing. And let's log in and see what, okay. So it seems like it's overvalued by 1.4%, but 85 is a peg ratio of 1. So that's a lot of times these quality companies will trade down to, a peg ratio of 1 in the worst of times. And that's the time you can start dollar costing into them. Let's look at what other things we're going to talk about.
It's much more interesting to buy now. If you're interested in owning Disney, buying now versus later. The Disney, though, they used to have a dividend. They don't give the dividend anymore. They haven't had one since 2019.
Yeah, the reason why they didn't at that time was their theme parks were shut down. In their ESPN, there wasn't any live content, for sporting events. So they were really hurting. They didn't have 1/4 of their income. So that's why they did that then. Now there's all kind of pressure. If things are back to normal, why aren't they reinstating their dividend? And I guess the argument is they're turning into a growth company with this streaming, and they need to put all their extra money that they would normally give into maybe the streaming or some kind of investments. So I guess they probably will reinstate it, seeing that the old boss is coming back in. But you see. Okay, so let's go back up to my talking points here. Okay, so that was Netflix. We talked about Net. It's still overvalued by 2.5%. That's a lot. So let me see. Perhaps at the worst of times, it did. Let's look at Netflix, because in the worst of times, Netflix, I bet you that traded down to a very similar Netflix. So we have a very volatile day today because of the options expiration. And it's not up as much as it was before. Okay, let's look at the chart of Netflix and see what it did during the pandemic. So 2.4 times overvalued. If we look at where it was in a sell-off. So it sold off 2 times in the last 5 years. It sold off during the pandemic, right there. 2000 right here. Okay, it sold down to 315, and then recently it sold off to 167. So if we divide the price it's at now, 336. I wonder why this is coming up. Okay. 336 divided by 2.5. 134 is its fair value. It'd be a PE of 17 at 134. So it traded down to 179, when it sold off in July of last year. So that's why we keep track of, everyone gave up on Netflix because it stopped growing, after the pandemic rush. And now it's becoming a stock that, they're actually growing subscribers now. And the other catalyst is they're going to make people...
I just saw they are growing subscriber. I thought the last report was saying that their subscriber reduced.
I think today's report said that they grew by like 6.5 million or something like that.
7 million, I think.
7?
Yeah.
Okay. So now they say that...
Yeah, expected about 4.5, but they grew by 7 million.
So the other thing that's good for Netflix, the catalyst for them, they say over 80 million households share passwords. So if they can convert some of those, they said they're going to crack down on that next year. So this year, sometime soon. So if they do that, or if they make like a user pay $5 extra for another user, I don't know what that could add to their total count of people. So that is the other thing to think about for Netflix. But I guess the time to have dollar cost in it when no one wanted it, but we can see when the PEG ratio gets down to 1, it's close to, if it's a quality company, it's time to start buying a little bit. It's good to look at it afterwards, but they do have competition, but I don't know. Netflix has a bigger variety of content than Disney, I think. So I would rather buy. I don't know. Netflix is still pretty expensive, but if it went down to 130 again, we'll watch it during the next sell-off. It goes down there. Might not. Okay. Let's look at some more things I had on my list of talking points. Okay. There is along with this talk, I gave a PDF file of this Wedgwood Partners. It's readily available on the internet. Let's look at it. It's basically a report of the end of the year report for a hedge fund, and they basically described, what they're holding and their performance, what we did good, what we did bad, and I did a quick check on the top holdings, and they're holding a lot of the stocks that we're following. So, and I said, wow, this is a lot of times whenever you have, really smart hedge funds and mutual funds that have unlimited resources for research, and they find and keep the same stocks we're following, that's a good vote of confidence whenever you're putting together and holding a long-term portfolio. And I was thinking about the word confidence, how important that word is when you're pricing a stock, and whether you're, what the multiple is for a stock. And so when you look at a stock to invest in, just think of that word confidence, and that is, in the end, the whole stock market in general has a certain amount of confidence in the stock, and that gives it a premium over other stocks with similar growth rates. For instance, Apple, we know from looking at it, it's only growing at 7% a year right now, but it's consistent 7% because they have residual income, and it didn't sell off as much last year because it has this dividend. It has 1 billion users they can sell to. They have, a new cycle of phones, et cetera. They have hiccups where they can't make as many, and that's a good thing to have. I mean, it's not good. There's more demand than supply, and that's not that bad because they usually buy it the next quarter. But my point with that is this Wedgwood Partners had very, very similar holdings, of what we were following. So I said, well, I'm going to pick out some of these stocks that they have here that we're not following to see if there's any good ones in here. But I did look at their letter, and I marked up a few things of what the guy was saying. So let's look at that. Okay. He basically, he still believes in meta platforms. He said that the stock trades at levels well below where they were trading before the pandemic. And much of the market's concern revolves around slowing revenue growth and aggressive reinvestment. So, you see, they think that Meta has plenty of room to moderate its expense and drive significant value by repurchasing shares. So this guy still believes in Meta. He thinks that as long as the next earnings report, which is coming out I set it on the calendar next week or the week after. If they say something like, we're not spending as much, we're cutting jobs, we're eliminating some expenses, then that'll make the market, it'll be in favor again. That'll improve that confidence in the stock. Right now, there's like zero confidence. It's trading basically at its growth rate, around 14%. And let me see. Alphabet is another one that they like. He said the shares continue to sell off as the market discounted fears of an advertising recession. And they have a discipline, and they have a multi-year time horizon. And they can tolerate this short-term volatility and, while holding it for a long-term gain. So that's the way I'm thinking with Google. I'm a long-term holder, and I know that this next year is going to be shaky to maybe negative 5%, maybe flat earnings growth, just because the whole recession problem. But they also think that the cloud and they already have a system in place to generate about 10 to 15% a year. So you see. And Apple also, they also believe in Apple. They're growing their revenues at 14%, but they've been hit by foreign exchange, and that's going to be better in the next quarter. But they say they have a lot of installed users, which is 1.8 billion devices, and they can generate 15 billion from services. So that's that residual income that allows the market to have confidence that they're going to meet their numbers or not drop their number. They have. So that's why this company continues to hold this, and I'm thinking it's going to grow 7% for a year or two until they come up with their next device, and then they're going to go into growth mode again. So let's see. This is another interesting article about popular stocks among hedge funds. We've been following the top 10 holdings of different mutual funds and money managers for a while now, but this is a place that basically went through and tabulated the top holdings for every hedge fund. So these are smart people. I mean, they're perform and they're smarter than us. And these are the top holdings. A lot of the ones are the ones we're following. Okay, so the ones that we're not following, we already go over all these, the ones that are not highlighted every week anyway, so there's no use going over those. But we'll go over some of the ones that are in their top 10. We already went over Disney, but some of the ones in their top 10 that we don't follow, to see if the hedge funds know something that we don't. And the other things are hedge funds owning stocks that you own gives you confidence in holding what you have. So they're holding it, the mutual fund companies are holding it, and they're not selling it, then there must be some kind of reason for that. So let's look at before we do that, what I'm going to do is I'm going to review just for 30 seconds what we're looking for in a good growth stock. And this, for the most part, these are growth stocks in that list. We like to see in this earnings estimates for future years, we'd like to see a straight line up. We like to see a straight line up for earnings for the past couple years. And we like to see, this is the stock chart, this the stock, and we like to see when the stock drops like that and the earnings are consistently up. That means it's dropping most likely on some kind of petty news and not necessarily affecting earnings. And that's Peter Lynch's favorite graph right there. And he likes the earnings over the price of the stock. And so these are the numbers we're looking for. We're trying to avoid companies heavily in debt. And return on equity is important, greater than 12. Profit margin, greater than 12. market cap we want bigger ones because they're more reliable. The forward PE, we want to be low compared to the growth rate. And the growth rate, we want it growing around 10% or more. And the PEG ratio, we try to buy it around 1 or so. But Warren Buffett's been known to buy PEG ratios of 2 to 3 if it's a real good quality company like Kraft Heinz or something like that. And so that's our little formula here. So we're going to look at these stocks here that we haven't researched yet. We're going to look at those and see how they match this formula we have. All right, so we already said that. All right, for earnings, Uber is a example of a stock that's, you can see by the red, they're totally unprofitable since they went public. And we know that their business model is they have these independent contractors serving as taxi people and delivering items, such as Uber Eats. And so the people that are driving, the biggest problem with this business model, the people that are driving aren't making money. They call it pocket change, but they do a lot of busy work. They're losing money in depreciation in their car. And before you know it, they're just doing a lot of work and they get $20 at the end of the week. So that's why I don't like this company. I mean, what's going to make the people stay and do that? And on top of that, well, they're losing money now, but there's a indication that they're becoming less and less. They're losing less money every year. So they're saying they're going to be profitable in 2 years, and then they'll be doubling their earnings. I'm sorry, could you say that again? Okay. So this is an example of a stock that is totally out of favor at this time, because any stock that has no earnings now, that is losing money, that it's a stock that's basically people don't, you can see by the price of the stock, it's down pretty much at an all-time low. And maybe whenever the economy recovers next year, people will pay for, moonshots like this. Because right now, this $4.87 it lost last year that's huge. And I guess what we can do is we could watch this stock whenever there's a major sell-off, because this stock will go down in half. Whenever stocks are losing money like this, they'll basically drop in half because people just don't have anything to attach to. Whenever we're looking at the quality stocks, we saw Netflix go down to a PEG ratio of 1, and that's the time we can start buying. But where's the bottom for this when it doesn't have earnings? That's the problem. And then if these are true and it starts being profitable in a couple of years, then when we look at this at a huge sell-off, maybe it goes down to here in the chart. That might be something for a super long-term part of your portfolio. But this isn't something Warren Buffett would be interested in. I know that. The other big problem with this is the company's business model is at risk, because if there's legislation where they force the people to be employees, that's going to reduce their profitability, and this negative will just extend forever until they go bankrupt, I think. So that's why people don't have confidence in this company now. This business model, it just doesn't make sense to me. I wouldn't want it. But the hedge fund people do, so maybe they know something we don't. Any comments about Uber? All right.
Nope.
We can see the forward PE for Uber is 416, and it has no PEG ratio. Okay, this is not a Warren Buffett stock. Negatives not everywhere down the line. This is really, I'm surprised it's the top 10 of the hedge funds, but I guess It's not for me. It's not for Warren Buffett, I'm sure. Okay, here's another one that's been in the news recently. They've had a turnover in executives recently, and they had a bad earnings report, so they went down. Let me see. Yeah, a lot of top people quitting the company. The CEO, one of the CEOs quit, and a lot of times when that happens, it means that the company's not going to be doing good in the future. But you can see that it's basically if these numbers, let me see, it's growing at 15 to 17%. Let's say 17%. So if we look at these numbers, but we divide these numbers and divide these numbers and divide these numbers, it's like 17%. Its PE ratio is 26. So it's come down a lot, but it's still overvalued by 1.52%. They have a good product, and I guess in a recession, this kind of product is not as needed. There's a lot of companies like this that are having problems closing deals because of this recessionary environment. So it's not like a must-have product like Microsoft Office is, perhaps. So right now it's like still overextended. So 1.5. So if you divide the price of the stock by 1.5, that's the target. It'll sell off in a bad market. So that's still it's not a good one. It's 1.51. That matches our expectations. And the profitability isn't that great either. Return on equity is like 0. Profit margin is 0. And they made a couple big acquisitions. I thought that, we used Slack for a while here, and they bought Slack for like a lot of money. I don't know. That wasn't such a great program to buy for billions of dollars. But they made some acquisitions that were adding to their debt. I think that could have been a major turn down for the company. Because I don't know how accretive that is. How much does adding Slack to, their products help? I don't know. Okay, Disney, we already talked about. It's going like 17%. It's still overvalued. What other stuff? Okay. The other thing is we want to always review our emotional graph and where we're at. And so you can see from the S&P, when we look at the S&P, let's look at the S&P again. Okay, we're back up 1.25%. So you can see for the S&P, people just get excited and greedy when it goes up to here. And then when it goes down, people get fearful, extreme fear. And then just when you think it's extreme fear, then people start getting greedy. Now, we're at neutral right now. We're like halfway between greedy and fearful. So that's why we're neutral. Actually, that graph is basically, when it's down like this, it's time to start buying. And when it's up at the top right here, like it's at right now, it's time not to buy. So we're in denial right now. But we could also argue that if Walter Deemer is correct, and we have a momentum right now in the market, this only happened a handful of times in the last 50 years, that we could be like right here, and people are starting to get neutral, uninterested. And then you have, we could be in this position where we make a big move in the stock market. And it's just when people are like afraid, it's that time, when we keep hitting this channel, the top of the channel, it's that time whenever people pile on and they have a fear of missing out. So we might, if we break out of this downtrend, we might have that fear of missing out. There's a lot of cash on the sideline where people, this delusional thing comes back. and if we have a good report by the Fed, they're not raising interest rates anymore, people could try to pile in. And you just have to be, for me, I'm neutral to any of this ups and downs. I just look at the numbers and make sure, my thesis is still good for all the companies that I'm watching. Any comments on that? Right. Okay, so we're still in a relatively good time of the year. This first half of the year is usually traditionally good. And then we have to remember that August and September are pretty much the worst times of the year. And let me see. Okay. Is there anything anyone wanted to go over? Any specific situation or stock?
I put it go on, Joe.
Sorry, just quick question. Any potential impact on the debt ceiling on the market?
Oh, I forgot to mention that. Right. The debt ceiling, we actually achieved a debt ceiling, I think, Thursday. So I think we have like a 2.1 limitation, 2.1 trillion. What is it, 21 trillion? Whatever it is. We hit that limit on Thursday. So we have to basically not spend more than that until the Congress approves it. But it's always approved in some way. There's all these people. There's Republicans and Democrats, kind of like they want these pet projects, and they want to. There's all these brinkmanship, like we're not going to pass something, but they always do. So you have to treat it as a non-event. This debt ceiling. If the market sells out because of debt ceiling, don't worry about it, because it'll probably never happen, and we'll always pass something at the last second. But if it did happen, we just would have to cut back on things, just to make ends meet. We won't grow as much as a country. We would, for instance, we wouldn't have as much economic activity. It would be really bad if we did. We would probably lose our status as the reserve currency for the world. It's like a major problem if we defaulted on our debt. But
wouldn't that impact the bond market then?
It would be huge. Our interest rates would go up.
The debt ceiling in general.
The debt ceiling. I'm not that smart. I don't know anything about that. All I know is if we defaulted on our debt, our interest rates would go up so much because no one would want to lend us money. And then we'd get into a situation where we have higher inflation than we have now. And we would have like a runaway currency. It'd be like nuts. If we defaulted on our debt, it'd be the worst than anything we've been through in our lives.
Yeah, I have no doubt that we will never neutral, but the debt ceiling playing in politics will definitely impact the market. The default on our debt is far-fetched. I don't think it will ever happen, at least for short term. Right?
Yeah, we have to treat it like a no-op. Like, what are they saying?
But the debt ceiling and the budget approval is definitely impacting, or at least will be short term.
Right. Well, I'm not an expert in that. I have 1 minute left. I'm going to go over. Okay.
I put in the chat a picture of the savings rate, the personal savings rate, and it had been. Let me see here. Been between like 5 and 10% for years going into the pandemic, and then it spiked up. But now it's really low. I think that a lot of people, for going into retail sales, I think we've had some retail sales misses here, where companies maybe raised prices, but their volumes went down quite a bit. That I think general households have spent through a lot of their savings that they got during the pandemic, and I think that's going to be a big pressure on inflation that people can't pay the prices and they're buying non-name brands or buying things that haven't gone up in price as much.
Oh, you know what? What I'm going to do right now is I'm going to. I saw a chart somewhere else. I'll send that chart whenever I find it. But what's interesting about this chart, what we can do is we can draw another one. Okay, this is the amount of debt of America, right? The credit card debt?
Yeah.
It's up to here now. So it's like the highest it's been ever. And we have the lowest savings ever. You can see we had a lot of savings because people last year, because of the pandemic, they gave us stimulus checks. But to go along with this chart is that's great for the banks, because you think if there's a high amount of credit card balances, they're making 24% on that, right? On these,
but also create a high rate of default too.
Yeah.
And I think people. So I think that your retail sales. I think all retail companies are going to start missing. I think that December was down 1.1% or 1.3%. And I think that people don't have the money, right? They've gone through their savings and they're maxing out their credit cards, and so I think that's going to hit. They're not going to be able to be buying things, right? Prices are going to they're going to be buying less, or they're going to be buying cheaper products, and I think the premium products are really going to suffer, and retail sales are going to be down. And that's going to be one of the factors in this recession that you're predicting in this calendar.
I kind of wonder how much of that coincide with the inflow of money into the market. Right now, we will have almost 0% interest in saving rate at the bank. I'm kind of wondering, people pouring more their money instead into the market.
And the bonds, so bonds fell last year, but there are now actually, if you're looking for savings percents, there are banks which will give you 2.5%, 3%. I know that my money market funds are now actually paying at the brokerage. It's still not low inflation, but I think that money in a savings account, you're using that because you want the physical bank mostly. If you're not getting a good percent back, you're wanting to be able to use the local services. But if you're not getting local services, then you should be putting it into a higher yielding savings account.
Right. So maybe not just that people have less saving, but rather they just reallocate to a higher interest money making kind of.
Yeah, but I think a lot of people just don't have savings. The savings have gone way down, and that they're just isn't. People had the money from that savings cushion from the stimulus, and I think that's going to be gone this year, and that's really going to affect retail sales.
Yeah.
Right. So, based on this chart here, it doesn't seem like there was a lot of inflows last year, but now this year it's not as much. Interesting. I'll look at that. Try to find a good chart on there are charts that say the amount of inflows for the stock market versus outflows. But if we start some momentum here, there's a very good chance, I think, of there being a fear of missing out. There's a lot of cash on the sideline for market participants, and if we have that momentum, right now one of the biggest problems with the stock market is we're meeting the 200-day moving average. A lot of people look at that. A lot of algorithms look at that. So if we look at, do we have the 200-day comparison indicators? Moving average, let's look at 200. We'll make that red. Okay, so we're meeting up with that 200-day moving average, and see, we can't get above that, and it's still going down. And a lot of market algorithms look at that, and they sell when it gets to the top of that, and we don't know. But if we could break out of that, there'd be a fear of missing out, and then there'd be a lot of inflows, I think.
I was reading that Lululemon on their earnings call said, that they were a lot of their sales in December were on discounted items, that people were buying things on sale. They weren't buying their shopping was really affected by the pricing. And so I think that's going to hit a lot of these consumer brands we follow, and retail outlets. I think across the board are going to be affected by that kind of earnings. This Q4, and I think Q1. I think that's going to be hard on a lot of retailers and consumer products.
Lululemon, they the thing to watch for Lululemon is their profit margin. Right now, these are really good numbers, 41%, 15%, and they're almost at a peg ratio of 1. And if we let's look at the earnings growth of that company. So basically, their business model is to make a workout outfit for $2 in China and sell it for $80 in the retail store. So that's how you get such great margins. If they can make quality merchandise people like to wear, and you pay a lot for it. Wow, that's growing. That's our straight line up. We have the stock market, the price of the stock going down, and it's pretty consistent. And you look at this quarter four, that's going up in a straight line, each quarter four, because that's Christmas season, right? And if we just quick look at what they're growing at, 9.92 divided by 11.41, 14%, 11.41 divided by 13.48, 16%, 13.48 divided by 15.21, 12%. So that's like 15% growth. And let's look at their 15% growth with the 27 PE. So 27 divided by 15, that's 1.8 peg ratio. So it's 1.8 times overvalued. But they do have like a niche, in this workout, comfortable clothing. And they charge a lot for it, and people like it, and they keep buying more. So that's their niche. I don't know, it's still pricey right now. I wonder what it sold up whenever the market was selling off. I wonder what it was selling for. So if it's 1.8 times, you divide the price by 1.8, 312 divided by let's say 1.5, 208. I wonder if we got down to 208. Full screen.
Nowhere near that.
Nowhere near it, really? Let's
Nowhere
see.
near that.
It went down to 208. It went down to 200 last summer. So that's pretty close. That's a peg ratio of 1.2 or something. So I guess next time we have a sell-off on a stock, it's when it goes down, like Netflix sells off, Walmart sells off. We're going to look to see if it's a peg ratio of 1, because that's like a good stock, for a stock. A good quality stock, peg ratio of 1. But if you have something like Uber that announces something bad and it goes down, you don't have that natural, where does it stop? It just goes down until the sellers are done. But it went down to a peg ratio of 1.2 or 1.3. That's in May of last year. I don't know.
Okay.
Must have been a bad earnings report. Not sure. Boy, I think I've exceeded my time.